Talk of a third round of quantitative easing in the US drove the markets crazy last week. Just a week ago, it seemed that the Fed was never close to adding again to its easing program in the near term. And this drove Treasury yield higher, together with US dollar, Japanese yen and other yen crosses. However, the Federal Open Market Committee minutes for August's meeting revived the hope of QE3 again and sent yield in the US dollar Japanese yen sharply lower. There were some jitters after Fed Bullard poured cold water over the speculation, but then Bernanke closed the week affirming that there are scopes for additional easing. The volatile price actions left the markets quite mixed and made Ben Bernanke's speech at the Jackson Hole Symposium this Friday very important. As mentioned, the outlook in the market is quite mixed for the moment, in particular the inter-market relationship. The S&P 500 looked to have topped after hitting a new 2012 high at 1,426.68, but then staged a strong rebound from Friday after news on Bernanke regarding easing. Treasury yield should have at least topped in near term after last week's sharp fall, but seems to have found a temporary floor. In the currency markets, US dollar, Japanese yen's rebound is finished and it is likely that a downside breakout would be seen eventually. But there is no follow-through selling so far and we'd possibly see some more range trading in the early part of this week. Commodity currencies weakened with stocks but didn't really follow Friday's rebound tightly. Meanwhile, European majors were firm as supported by expectation of the European Central Bank's actions in September, and maintained gain against both the US dollar and yen. The overall development left the Canadian dollar and Aussie dollar as the weakest currencies, in particular against the euro and Swiss franc. It's indeed quite hard to find tradable pairs this week. But we'd firstly remain skeptical on stock strength. Secondly, we'd stay bearish in commodity currencies. The weakness in the Aussie dollar, Canadian dollar keeps us preferring to short Aussie. Meanwhile, we'd tend to continue to avoid European majors. US dollar, Japanese yen might consolidate this week and we could find some short covering for recovery even though a downside breakout is eventually expected. Hence, for quick trade within the week, we'd prefer to short Aussie dollar, US dollar. Meanwhile, for short-term trades that could carry over to the week after, we'd prefer shorting Aussie dollar, Japanese yen. The Fed released another dovish minutes for the Federal Open Market Committee meeting in August. As the minutes indicated that many members believed that more monetary easing measures should be implemented soon unless upcoming economic data showed a substantial and sustainable strengthening in economic recovery. Further monetary easing has now become a matter of when, instead a matter of if. Policymakers consider discussing a variety of easing measures, ranging from language guidance to balance sheet expansion. St. Louis Fed Bullard reminded us that the minutes were for the July 31st to August 1st meeting and were a bit stale because we have some data since then that has been somewhat stronger. In particular, that was actually before July's non-farm payrolls number, which showed a gain of 163,000 and a stronger than expected retail sales. However, on Friday, it's reported that Ben Bernanke sent a letter dated Wednesday to Darrell Issa, the California Republican who heads the House Oversight and Government Reform Committee. In the letter, Bernanke noted that there is scope for further action by the Federal Reserve to ease financial conditions and strengthen the recovery. After all, expectation on Bernanke's Jackson Hole address on August 31st is now quite high and we'll see if he delivers. In Europe, it's reported that the European Central Bank is considering various options for its bond buying plan. It's said that the central bank could set a target but keep it unknown to the public. Meanwhile, it's also reported that the target could be a predefined band of reasonable width. And with that, the ECB could be allowed to reward or to punish a country on implementation of the reforms. But the ECB will likely wait for Germany's constitutional court ruling on the European Stability Mechanism before unveiling the details of the bond buying program. Regarding the program, rating agency Fitch noted that sovereign bond purchases by the ECB in the secondary market and primary market purchases by the European Financial Stability Facility or European Stability Mechanism would likely be credit positive and ease downward pressure on sovereign ratings in the Eurozone. Fitch said this could allow the sovereign to retain affordable access to market funding. However, Fitch also warned that if the ECB's bond buying is to substitute, rather than support market access, the reliance on policy-conditional external financial support would not be consistent with a high investment-grade sovereign rating, and prolonged reliance on official external support will place further downward pressure on sovereign ratings. Greece was also a major focus last week as prime ministers met firstly with EU Juncker and then German Chancellor Merkel and French President Hollande. Nothing special was released though. Merkel said at the post-meeting joint conference that she is deeply convinced that Greece will make every effort to solve the country's problem and emphasized the tough austerity measures were to help Greece reach the light at the end of the tunnel. She also reiterated that she wanted Greece to stay in Eurozone. Before that, Merkel met with Hollande to unify their positions on Greece and encourage Greece to stick to the reform path, even though it has demanded a great deal from the people. Japan's July trade report evidenced that the country's economic recovery was dampened by global economic slowdown. While the headline deficit figure was largely in line with market expectations, the steep decline in exports, due both to global economic slowdown and strength in the Japanese yen, generated much concern, not only due to the free fall in shipment to Europe, but also because of the accelerated pace of the decline to Asia, especially China. The report suggested that Japan's economic growth would increasingly be reliant on domestic demand, which would unlikely be sufficient to boost the country's GDP growth to a meaningful extent. The report signaled that dismal exports would continue to trim Japan's growth in the third quarter of 2012. The minutes for the August Reserve Bank of Australia's meeting contained few surprises, as most of the issues were covered in a quarterly statement on policy which was released several days after the August meeting. The minutes confirmed that the bank acknowledged the peak in mining capital expenditure and the improvement in the outlook for housing construction from the second half of 2012. While keeping the cash rate unchanged at 3.5%, policymakers delivered no hints on the next move. Yet, we believe another rate cut would be announced in the fourth quarter as unemployment will probably increase due to tight financial conditions and fiscal consolidation. Governor Stephens said in his semi-annual testimony that the peak of the mining boom will occur within the next year or two. But he stayed cautiously optimistic for the global economy and expects the bank to be well equipped to handle any turmoils. The Central Program for Growth is close to trend, with inflation staying inside the 2 to 3% target range, with current interest rates a little below medium-term averages. Meanwhile, he noted that the Swiss National Bank's purchase of Australian dollar a remarkable thing, and is a picture of how bad the world is in Europe. And he's seeing more official flows from central banks and governments recently.